All right, you're live. I'm sending out emails now.
Okay, guys, you'll have this hit in your inbox and text message soon. I'll just go over it and then we can go into Q&A. So yesterday we had a very odd ball trading day. I'm sure many of you were alarmed because I've been warning you, if the TLT and SPY don't keep their relationship, which is where TLT is the safe haven asset of the world, allows you to hedge your equity exposure. If that relationship breaks, all hell will break loose and we'll be in a Mad Max situation in short order. And so as we saw, we had that relationship break down into the close yesterday. My best estimation as to what caused that is severe dollar shortages in the banking system, which we can see showing up in the repo markets, dramatically getting oversubscribed and quickly increasing. One, two, the low price of oil with the oil battle going on between Russia, Saudi Arabia, I believe really took a massive loss to anyone using a aggressive bullish oil strategy. And then finally, we are also probably seeing a wave of risk parity funds taking some massive losses because once again, if they are using leverage and doing the same strategy as we are, just some small movements like we saw at the end of the close yesterday could cause them to have massive losses and have to liquidate. So depending on how leveraged you are, that move yesterday could have been destructive to your strategy, especially if you're using leverage in the size of something like 10 to 1 or 20 to 1. Now we're not doing that.
Yep. Hey, Jason, just real quick, will you explain what a risk parity is to the group? I just want to make sure everyone has that understanding.
Yeah, so risk parity is the TLT SPY strategy. And when one goes down, you leverage into the one going down and take profits off the one that's up. And then you just bounce back and forth. And so that's been really made famous by Ray Dalio. And just about every money manager on the planet uses that to protect their portfolio. So the Treasury must protect that 30-year Treasury. And I believe they will be rolling out some massive strategies to do so. Not just here in the States, but also in other central banks. So I'll get into what the central banks are doing, what I think they'll do. Let's just cover what we're changing in our portfolio so that we can all understand the trade alert. So today I am adding a aggressive call option that's only in our pro portfolio, which is per $100,000 total. This is regardless of what it's invested in, but per $100,000 total, you have following this program, we're issuing a trade alert to buy to open the January 15, 2021, 170 TLT call option. In our model portfolio, that's a $1.5 million portfolio, so 15 contracts. Let's look at that trade. Here is the option chain. I'm booking it with the asking price at $9.95. Again, the strike is 170, and we have 309 days. Hopefully, we will see this shoot to around 180, which we just saw recently, within 160 days, and that'll be perfect timing to liquidate that position. If we do hit that, it will be a gigantic gain with relatively low risk. It also is serving the purpose of allowing us to step out of the TLT ETF if we think there is a serious risk. At this point, I don't think there is yet, but this would allow us to completely get out of the TLT ETF if there is further scare in rising yields, which again, I think central banks are going to come in and force that yield down based on the fundamentals of what needs to happen for America to get through this disaster that's still just barely starting to unfold. So again, that's the call option that we're recommending, regardless of what you have following our system. Per $100,000, no more than one option contract is recommended at this point in time. And again, I'm using the asking price. Hopefully you'll get filled closer to the mid price. My expectation is, again, to be able to get to 180 by 160 days or 150 days into the time premium. So we should have 150 days of time premium and hopefully blow past our strike point in the coming months. So that's the intention of this trade. And once again, by having this trade on, if we do see further downside stress in the treasury market, this will allow us to completely exit our ETF position and still have the exposure to where we are extremely confident this market needs to move towards. So it allows us to have that exposure with low risk. And that's the trade alert for today on the TLT. Now, the put options are just absolutely insanely expensive. So I'm not buying a new put option. You still have a put protecting your ETF expiring tomorrow, and you can sell that at the close. It may have a little bit of value, but perhaps not too much. Okay, so that's the first move we're making today, is to aggressively add a call option to our TLT position. You should still have 40% of your assets in the TLT. A common question has been, should I go all in on the TLT? If I thought you should go all in on the TLT, I would tell you to go all in on the TLT. I absolutely do not recommend going all in on anything for that matter, much less the TLT. Okay, the next step is to increase our ratio of the TLT to GDX and add a downside put. So the thinking here is that we're seeing not only rate cuts, but quantitative easing at the same time. So a lot of people love to go pull up charts of, for example, 2008 and point out that gold didn't go up until 2009. In fact, that it crashed in 2008 alongside stocks, which of course I'm very aware of. But again, this is different because these products are in general reacting to monetary policy and not necessarily to the stock market. Now, the Fed may be reacting to the stock market, but these assets are more correlated to the actions the Fed takes. So the ECB just announced no rate cuts this morning. However, an expansion of quantitative easing. My expectation in the US is aggressive rate cuts and also an expansion of repo plus some manipulation in the treasury market. And what Bank of America was speculating is that they may start doing QE for that 30-year treasury and essentially put a put option under the TLT for us, because they do need to raise likely trillions of dollars in the next 2 years to cover the costs of this catastrophic economic slowdown that the world's entering into. So what's the point of the put option? So once again, we were originally at a 1-to-1 ratio of TLT to GDX, which was a little bit under the 10%, which I've been rounding up to. With TLT rising and GDX falling, in essence, our position has begun to get much less than 10%. So to keep life simple, my recommendation in ratios now is a 2-share GDX ratio to 1 share of the TLT. Now, this is only related to our Pro program. I have not made any decisions on making any adjustments to our buy and hold portfolio. If that buy and hold portfolio does make adjustments, it will be issued on Monday. Okay, so we're buying the in the money GDX put option expiring on May 15th. Let's look at that option. This is the strike. And again, I'm booking it with the asking price. You might save a little bit getting the mid price. And again, I'm buying 1 option contract per 100 shares of GDX. What's the play here? Well, essentially, I expect that GDX will go up at a greater pace than the cost of our insurance. So we've guaranteed that we get no less than $23 minus the cost of this put option by entering this trade today. So we are locking in our maximum loss at this very moment in time when you add that put option. Okay, so the maximum loss is essentially the cost of your put. So we really cannot lose a penny more than we already have in the GDX position after we increase the position size by twice and then add the married put. So once again, my expectation is a crazy combination of rate cuts, increases in repo, and quantitative easing by central banks, which is going to pull resources out of the equities market, drive it primarily into the bond market, but I do expect the gold market to slowly but surely react to an expansion of dollar supply, which should make gold go up relative to the dollar. So the big push in gold, I believe, is in the books in the near future based on a lot of these banks talking about not only doing rate cuts, but quantitative easing at the very same time.
Hey, Jason, I have a question about, so on the ratio, not the option, but the shares of GDX, the program calls for 100 shares of SPY as the base, which I know we're in cash on that part.
Yep.
But for every 100, we'll call that, the single unit, you have 200 shares of GDX and TLT, but now you're saying that really should be 400 shares of GDX. So 100 SPY, which we're in cash, 200 TLT, and now 400 GDX?
You got it.
Okay, because I was 200 GDX.
Yep. So we're, if you had a 1-to-1 ratio, you should now have a 2-to-1 ratio. But keep in mind, I'm not just doing this naked. I have invested in that put. Okay, so let me go through a little more of the trade alert. We gave up a lot of the profit. I did not anticipate the TLT having a pullback during an extreme panic, but I do understand that the root cause was big investors, and a lot of them losing so much from the oil collapse that they had to sell everything. So it's unfortunate we didn't take some profits off the table. However, the fundamentals all point to no changes overall. In fact, you can see the general point of this webinar today is to increase risk and to add a little extra protection. So let me continue through the trade alert. We have this aggressive call option. And again, this will allow us, if we do see further downside pressure on the TLT, which I don't think we will. I think that's going to be fixed with Fed policy before Friday of next week, which is when our first call option expires. So I still think we can make back a lot of the drawdown we've seen today. But if not, again, this will allow us to step aside and have plenty of exposure that's leveraged in the options market. So perhaps this pullback was a blessing in disguise. Okay, next we'll review the GDX again. By having the in the money put, which is above the trading price, you're locking in your maximum loss today. GDX could crash 50% over the next 60 days, and we're only losing that $2.32 or $232 relative to $2,300. So that's still a potential loss of 10%, but no more. And again, to generate profits, we will need this to appreciate greater than 10%. So we're expecting a relatively large move in gold miners. And again, the fundamentals there is cheap oil plus rising gold is very bullish for gold miners. And again, a lot of people like to point out in 2008, hey, gold miners crashed with stocks. Well, very aware of that, but there was not QE during the 08 crash. That began in 2009. So this time around, it's not the same. We have QE, we have repo, and we have rate cuts, and we have it happening globally, and it's just getting started. They are just starting to figure out how the impacts of this virus are going to wreck the economy. Okay, so what I want to do now is review our positions and our content schedule, and something I expect to take advantage of on our Monday, Wednesday, Friday, soon as we think the volatility is reaching a peak. So probably VIX hitting around 90 to 100 is the magnitude of a crash that will be unfolding. So I do think we are still a bit early on this, but so Monday, Wednesday, Friday, as you know, we reserve 40% of your total assets for the SPY ETF. Currently, this 40% allocation is in cash because I'm expecting an incredible stock market crash. So this is the same text we presented last week. It's starting to come out into the market price action. And I still think there's a lot of downside risk ahead. So that's why we're still staying in cash. In replacement of the SPY trade alerts, we've been issuing near the money TLT, gold, TLT, and GLD call options until an equity buying opportunity presents itself. I have a very diversified group of healthcare and biotech, as well as medical device related ETFs that I believe will be the primary benefactor of the bond purchases, or rather the bond auctions that the Federal Reserve is about to massively ramp up. So again, I think this will cost trillions of dollars, and it's all going to be pumped into healthcare related sectors. Now, sure, will e-commerce do well? I believe so. But I think the exact direct injection of capital that the government's about to raise will be directly handed off into healthcare. So I do have a set of ETFs that give us a very beautiful exposure. I just want to see, I want to see the sell-off. I probably want to see the VIX pop above 90, and then we can start looking at strategies of how to put our equity portfolio to work. So that would replace the SPY for a period of time. And the strategy on that would be to essentially just trade it on Fridays with a weekly married put. And so we would just buy a cheap put option to protect the underlying and let that expire each Friday until we do see a solid recovery underway. So we're probably a bit early out on that. Next week, or perhaps in the bootcamp webinar, I can go through the ETFs I have in mind. And again, this will give you exposure to the exact companies I believe will be handed billions, if not trillions of dollars in the coming years, and will most likely be the top benefactors of what's unfolding. Now, once those things have a massive rally, then I look at getting back into the SPY and doing our Monday, Wednesday, Friday option caller. But again, we're quite some ways away from a bottom in stocks. And I do believe just the general selling will continue to create some volatility in the assets I'm interested in picking up. So I still think being a little patient on that will pay off. Okay, so on Thursday, we trade the TLT, GDX, EEM ETF. We're in cash on emerging markets. In fact, we just have a put option, which I believe at least earlier today was up approximately 1,000%. We're still holding that. On GDX, we've doubled down. TLT, no change. The put option protection has become too expensive. You'd have to spend somewhere between $5 to $10 for a decent put. And that's really the maximum gain I see us in the time period we'd buy the put. So I'd rather than buying a put option to protect that 40% TLT position, instead we've bought this aggressive call option that will allow us to have the exposure we want to the 30-year treasury and give us the ability to walk away from the ETF if it's not performing how we expect, or if the Fed doesn't deliver the rate cuts and the manipulation of the bond market that I'm expecting. Essentially, I think they're going to start issuing a lot more short-term debt and then essentially buying that 30-year treasury anytime there's people trying to sell it. So they're going to essentially force the yield to slowly go down as we ramp up our debt issuance, which again, I think is going to be extremely large to handle the crisis unfolding. And so with Trump's speech last night, we finally saw him change his tone. And I believe this will be a series of speeches that get more and more aggressive in terms of what we're going to do to combat the spread of this disease. So in our portfolio, again, like Mark did indicate, we doubled our GDX position, but we've also dramatically increased the downside protection with the in-the-money $23 put expiring May 15th. So a lot of people want to know, why is gold selling off? Why are we buying this when it's crashing? Again, I would just indicate that you want to own gold if you're going to debase your currency. And if you issue a lot of bonds and expand the repo and balance sheet of the Fed, then you're going to debase your currency. So I do expect all countries to have to devalue their currency by issuing lots of fiscal spending to once again deal with the spread of this disease. So with that said, why is it going down? Well, I think that we've just had so many people blow out their portfolio with 100% losses that they're liquidating everything to cover negative positions and survive or not go into negative territory. So hopefully that will start to slow down here. Regardless, remember we have that put option for 60 days. So we just really need it to pop up above 25 to go into the profit zone within the next 60 days. And I think it could go significantly higher than that. Based on all the news I expect to come out in the future from central banks. And probably right now they're all brainstorming what on earth they're going to do to keep everything from imploding. Now, if you're in our boot camp, we have a long SLV call option that's a 2-year leap, not up, but no change in that position. We have a long QQQ position, which is up, and we're still holding that. So we'll go over that in more detail in the boot camp. Today's boot camp, we're going to once again review the 2 open positions we have, whether it's a good idea to still get into those. Also look at these equity ETFs I'm interested in and review our overall strategy, as well as answer any questions about potential announcements the Fed may issue. So it's going to be more of a strategy review and not a normal module lesson today. I've just had to put so much time into studying what's going on that it won't be a normal lesson. Okay, so that is a review of the strategy. Let's go ahead and open up the mics, Ryan, and see who has questions. Starting with Anwar.
Hello, good morning. I just joined you. I always have work in the morning, but I bought GLD outright, and I bought GDX, and all are down the drain. And I bought a call on GLD as well, and it's down too, which is surprising. Then what else? TLT, I have. I am not following what you say regarding 40% of your cash here and stuff, because I just joined, so I'm still learning and trying to manage things accordingly. So the TLT, I bought a call based on the other day recommendation at 167.5. And that's all what is in the green. The rest is all in red.
Is there a question?
Yeah, gold was supposed to be higher, right, with the plunge?
No,
GLD?
no. So first of all, we never told anyone to buy the GLD ETF. In fact, I've
No, but yeah, I'm not blaming anybody though.
Okay, so your question is why is GLD down?
Yeah, why GLD and GDX is down? And then you said buy a put. Is it sell a put on GDX or buy a put on GDX? I didn't get that.
Okay, so yeah, let's do, so first of all, yesterday, a lot is, so the intro of the webinar was that yesterday, a lot of traders who were bullish on oil and using leveraged risk parity strategies, which is a combination of equities and long-term bonds, suffered massive losses and had to liquidate their whole account. So we saw everything go down at the same time yesterday: stocks, gold, treasuries, crypto, you name it. So the noise in the market yesterday was that we had some massive losses and people had to liquidate everything. So that can make it difficult for traders because you expect the SPY to go down and the TLT to go up. So I would ignore that noise. And as you can see with our portfolio, we've in fact added risk to the same trades that we've been recommending and not reduced risk. So that's one. Two, gold is not going to go up if stocks go down. That's a very big misconception. If you increase the supply of dollars, that makes the relative value of gold go up. So we're expecting that central banks will be printing money, and that's why you want to be long gold. And so the ECB, which is a very large central bank, just announced this morning, not rate cuts because they're already at negative 0.5, but they did announce a substantial quantitative easing program. I expect the Fed in the next several days to do a combination of rate cuts, increase repo, and plus some form of manipulating the bond market to be favorable to bond investors. So we have doubled our GDX position and purchased, not sold, the GDX, the 515 $23 strike GDX put. Does that answer your questions?
The last one you said you increased your position on GDX put, you said, or?
Yeah, so here's the breakdown. So with $100,000, you would have 40,000 in cash to buy the SPY when alerted, 40,000 in the TLT, and approximately 12,000 in GDX with a put protection.
Somehow I'm lost. That's okay. Because I bought GLD outright, and maybe that was a mistake.
So we've been issuing GLD call options, which I think are a very good trade right now.
And I have that too.
Okay. So yeah, so GLD is owned by a bank that we don't trust called HSBC. So that's why I prefer to buy call options on it, betting up versus holding the underlying. The fear is that if they were lying about their gold reserves, or if they're just company in general were to go bankrupt, that you have a large exposure to the risks of that bank, which I don't want. So I've been issuing GLD call options, which reduce our risk and give us leverage and exposure to spot gold going up. So I still stand by those trades, and we're still long those trades.
Mm-hmm. Even it's down, eh?
Yeah. A lot of these trades go down for short periods of time, and then it's, but yeah, we have not changed. Let me review what we have in our call options, which I do need to update the value on those. So currently we have open the 320 157 TLT call, the 327 157 TLT call, the 43 157 TLT call. Then we have the April 9th 158 GLD call option. And we have the April 17th GLD the April 17th GLD call option. Yesterday, we added the 417 TLT call option. And today, we're now adding this very aggressive 170 January 15th, 2021 TLT call option. So what's in your portfolio right now? And we can see how close you are to what I'm recommending.
Other than the ones that I already have before.
Just tell me what ETF you have, how many shares, and I'll do a lesson for the group as to how your portfolio compares to mine.
Okay, there's it. I said before that I have TLT, a call, and that's to April 3rd.
Okay, 43 157 TLT call. How many?
10
10.
contracts.
Okay.
Then I have GLD. I have 1,000 shares.
Okay.
And then I have GLD coal, 5 contracts.
Which expiration?
Expiration 27th of March at 158. The rate, that price was when I bought it. And what else I have? I have GDX.
Wait, GLD. So wait, GLD call 158 with the expiration of what?
March 27th.
Okay, so that's not anything we've endorsed.
When the price was 158, I bought that call.
Sure,
Mhm.
but we've only issued a April 9th and an April 17th expiration.
Okay,
So you've bought the March 27th,
yes.
and you have how many?
I have 5 contracts.
Okay.
And then I have GDX, 2,000 shares
Okay.
at 28.
Okay. The where you bought it doesn't matter for what I'm gonna teach you here.
Okay, let me write what you say.
Okay. How many shares of TLT do you have?
TLT, I don't have, just the call.
Okay. So
The
you're not
10
really following the program in any way, shape, or form. With the only trade on here that I've issued is this right here.
Because as if you recall, my money is tied up with lots of other shares, and I cannot say, okay, 40% is going to be on this and whatever. I don't, yeah. So without
Okay,
explaining
tell me
to
about your Microsoft Alibaba position.
I still have, I sold some.
How many do you have open right now?
Right now, I have 1,000.
Okay, and in Alibaba?
That's Baba. That's Baba. I own right now 1,000.
Okay,
And I own Microsoft 1,500.
okay. And how much cash do you have?
Right now, I am all in the red.
No cash?
I can, but when everything is down the drain, I don't want to bring more cash.
Okay, sure. Well, I'm just trying to get your total strategy because, as you know, I have a huge cash position. So I'm not telling you to invest the cash. Just if you could tell us what you have on the sideline, that would help.
I don't know how to explain that to you, but let's say I could bring as much cash as I want, up to $500,000, let's say. But because now I'm in the deep red, it will be more risky for me to bring more cash, especially that I'm not comprehending 100% the new program with you yet.
Sure, sure. Well, this is a great lesson for everyone
Yeah.
and easy to teach. So let's see, what's Alibaba worth right now? 185.
185. I bought it at 222.
Okay, so what you bought it at doesn't matter to what I'll tell you to do. And I'm
Okay.
sorry about the loss. That sucks.
It's not yet lost, but who knows?
It's gonna go, well, okay.
I got you. I know what you want to say.
Yeah, I believe there's a lot more pain ahead in the very near future. Okay, so let's just analyze how Anwar is positioned, and we'll compare it to what we've been teaching. And then we can compare results. Now, sometimes people try to outperform me, and people who took profits on Monday on TLT are outperforming me, at least at this moment in time. So I'm not going to tell you that you have to follow the program down to the T. But let's just look at what I'm recommending versus what you've done so that we can all learn from this. Now, how much would you say you've lost in March so far? Is there any from your equity positions?
Quite a bit. I can't tell you a number, but I am down altogether $336,000.
Okay. So you're down about 30% total,
By 25%.
25% total. Okay. So I gave up some of my profits. I think we'll get them back, but by following our trades to the T and really getting screwed this week. I mean, it's very rare that stock market tanks, hits limit down, and we're not getting a huge payday on the treasury market. So that's a very unlucky event. But even with the most unlucky event, we're still up. So I do want to point out that, you know, had you followed the system to the T, you'd really be in a lot less pain today. And so now Anwar's in this position, which I've seen time and time again. He's down probably, what are you down? Probably 25% on these.
Yeah.
This is a typical thing I see investors do. They don't want to take that loss for whatever reason. It's this mental roadblock that they want to hang on for it to bounce to get a better. In fact, I would probably guess, Anwar, that you're hoping that not only will it bounce up, you probably don't want to sell it ever, is what I'm guessing. Is that kind of your mentality on that one?
Once it becomes in the green, I'll sell it. I'm not holding and hoarding it. But
So
when
wait,
you are,
but you believe it could go back to the green and then not. So let's just think about that mentality. So Anwar is down 25% on a huge position. This was probably worth $500,000. Now it's worth 350. And so he's telling me that I want to get back to even for my losses and then I'll get out. But if you really thought this was going to go back to even, don't you think it would continue to climb higher and higher? I mean, these are really the two top companies in the, you know, these are the two premier companies in the world. Microsoft, for sure, for America is the single safest bet ever. And all investors that are top hedge funds, that's where they, if they think there's a safety problem in the markets, they just pile up on Microsoft.
Mhm.
Okay. But tell me this, if you thought this would really rebound 25%, why would you sell when you got back to break even? Don't you think to get back to where we were at, we'd have to resolve the underlying cause of this sell-off?
It's not because Microsoft is bad or Baba is bad. It's something that is not directly affected by those companies. Baba was supposed to be close to $500 a share by July, but then nobody estimated the problems we are going through right now.
Yeah. So I've been warning of a stock crash since I think sometime in January.
I just started with you not too long ago.
Sure. But we've been telling you to sell stocks, right? That it's going to get worse and worse. So here's all I want to tell you is that, look, if you really thought that these were going to go back 25% from here, then why wouldn't they continue marching higher from there? So if you really thought that these could retrace 25% or even 12%, then I'd argue that everything's back to normal and these companies are poised to go to those targets. You know, Microsoft's poised to go up towards 300 in the next 3 to 5 years and Alibaba up to 500 in the next 3 to 5 years. But if the underlying problem is actually unraveling and getting worse, then I would argue that this is just the very start of the sell-off for these companies. So that's going to be my only advice to you on this, is that and I've seen this time and time again, people have a loss and it just kills them. It just kills them to take that loss. And they think they don't actually have the loss as long as they hold it. So they're okay with the big unrealized loss. But when it comes to closing the position out and putting it into a closed position, that just kills investors. I don't know what the mentality is, but I've seen that time and time again. So my only warning to you is that I believe it's going to get far worse in the coming months. So be careful. You might, if you do want to try to hang on to that, downside protection is extremely expensive. So if you wanted to do the same strategy, let me just kind of draw a parallel for you. So I'm dealing with the same problem. You could argue I'm making the same decision you are with GDX today. Okay, so let's just look at how I'm trying to play GDX, because I believe GDX should go up, but yet the price action's not doing that now, is it?
No, surprisingly.
Okay, so we're both in a similar predicament here, is that you don't want to sell your Microsoft and Alibaba because it has a loss and you think it should go up much higher. Okay.
Once
Now-
we go through this this storm, right?
Right.
Once this is settled, those stocks are very strong stocks, and they will go up once but I don't know when the storm is going to settle.
Right. That's the problem. So my anticipation is that this will take no less than a year to resolve, and probably 2 years. So you're in a predicament. Now I can buy downside protection on GLD for 2 months at a cost of 10%. And I'm using about 12% of my total portfolio. So let's just talk about this trade. I think this is a good lesson for you. If you really want to hang on to that, I clearly don't think you should. And I understand that it is painful to realize the loss. It's the same as an open loss. I've seen it for the last decade. I've seen it, so I understand. Okay, so let's just look at how I've gone about sticking to my guns and believing that gold should go up because central banks are going to do quantitative easing. They're going to debase their currencies, and that in enough time will make gold rise. If I have low oil costs, then I can mine gold even cheaper than before. And so I love this gold position, but yet it's not behaving the way it should, right?
Mhm.
So look at how I went about doing this. So I told our investor base today to double down on GDX. Now I like GDX because it's American Canadian companies.
Let me understand what double down term means. You said we double down GDX.
Yeah,
Twice
What
as
does
much.
that mean in layman language?
sure. So let's look at the trade alert today. Let me teach you the married put, and then we'll go look at the allocation, because what you're doing so far is pretty much, you're following maybe 5% of the program right now instead of 100%. And while there have been a few people who've outperformed me, not many, and not very long periods of time. And so we certainly, just to show you, Anwar, how well the strategy works, the biggest loss I've had in a closed month is 1%. So your loss in the last 2 weeks, or at least to start off the year, is something like 30 times greater than I've ever had.
Mhm.
Okay, and this is through a bull market and a bear market. I mean, this was an extreme bull market, and this is an extreme bear market. So I do think that alone shows you that maybe there's some rhyme and reason to what I'm teaching. Okay, but so the married put, that's the strategy. If you're buying into or if you're trying to hold into an asset that's not performing in your direction, then I like the married put strategy. So we just saw a huge sell-off in gold, which I believe was caused from oil traders losing more money than they had. So they had to sell everything in their entire portfolio. So we had this bizarre day yesterday where stocks, bonds, oil, gold, and cryptocurrencies all went down. That means someone just had to liquidate everything in their entire portfolio to cover a big loss. Okay, so it does not make sense. So if I believe that oil prices are going to remain low, which makes it cheaper to mine gold, and if I believe spot gold is going to rise, which I do, then I want to buy the dips in gold miners. Okay, but I also need to listen to the tape. The tape is telling me people are selling the damn ETF, right? It's down 10%. So what's our strategy to have confidence to buy this ETF today or to continue holding it? So my trade alert today was to buy twice of what we already own. And I'll go over the allocation in a second. But I didn't do it naked. Okay, I bought the put option in the money. Okay, so I'm buying a 23 strike put with 64 days of expiration to protect my position for the next 64 days. Now, what's my maximum loss? Well, the put option guarantees I get $23 per share. And when I placed the trade, it was at $22.81. Okay, let's just pretend it was at 23 flat, just to make life easy for calculation.
Mhm.
Okay, so my maximum loss here today is the $232 I've invested in that put option. And that's really easy math. That means I can lose 10%. In fact, I'm realizing a 10% loss on this position the second I place this trade. The only way I make money is if GDX goes up more than the cost of my put in the next 68 days. So I'm betting that GDX will go up by more than 10% in 60 days to make a profit. Okay, if it goes up 5%, I lose 5% because I invested in a put option that costs 10%. If it goes up 10%, I break even. If it goes up 20%, I make a 10% return. Now, what happens if GDX falls off a cliff? What if it goes down 20, 30, 40, 50% from here? I lose only the money I invest in my put. So this is a popular strategy when you're buying into an asset that's struggling, but fundamentally you believe it should be going up. And so gold fundamentally has all the best elements I've ever seen coming together at one time right now. So I will continue this trade the lower it goes and get more and more aggressive because I expect banks to debase their currency by using massive fiscal spending and doing forms of quantitative easing. So let's go back to how you have your position here. So you're sitting a sitting duck right here. Okay, volatility index. This is what you got to realize. So the VIX is a good measurement of how expensive it is to buy crash insurance. Okay, so most investors who've been around the block and have had pain like you are in right now, they know the married put strategy. They know that if they're going to buy an asset, it's smart to have at least some kind of downside insurance to protect it. Okay, so if this is elevated above 35, much less 68, that means the house is on fire and there's really no point in buying insurance. It'll cost almost as much as the house. Imagine your house is on fire and you call up Allstate or whoever and ask them how much it'll cost to buy insurance on your house. It's going to cost the same amount as the house. So you might as well not buy it, right? Well, the same is true for the stock market. If the VIX is above 35, much less 50 or 60, that means the house is on fire and the cost for downside protection is absolutely outrageous. So it becomes a self-fulfilling prophecy that people are too timid to buy stocks when they cannot purchase downside protection at a reasonable rate. So that makes it extremely dangerous to hold this position. You are essentially counting on one of two things to hold Microsoft and Alibaba. Okay, number one, which I think they should do, I think the United States should freeze the stock market for 90 days. I don't know if they could, but that's probably one of the few things I believe that could save the stock market from collapsing far further than it is. Okay, so we have seen governments starting to change rules in their equity markets and banning short selling, forcing big banks to be net long, all sorts of manipulation to try to protect their equity markets. So maybe they do that. Two, the Fed announces that they're going to purchase equities themselves. Okay, that would cause quite a hoopla. It would cause them to dramatically expand their balance sheet. It would weaken the dollar, which would also make gold go up. But outside of those two things, unless you think the disease that's spreading like wildfire is going to suddenly stop, I'd argue it's crazy to hold this position until the VIX has collapsed. So I wouldn't want to start looking at equity positions until this most likely pushes towards 100 and then starts to pull back down. And I think that's when you're going to get close to a reasonable bottom to start looking at equity investments. Okay, so the VIX is expensive. The house is on fire. You're not going to be able to get downside protection without realizing massive losses. So it cost me 10% to protect my GDX position today for 60 days. For you to protect Microsoft and Alibaba, and again, I think this is going to take no less than a year to play out. You would probably have to realize a 30% loss today to buy adequate downside protection that covered you for a year or more on those two positions. So that's all I'm going to say about that, about the equity position. It's playing with fire to buy equities when the VIX is up because you can't buy downside protection. Okay, so first of all, let's talk about equities. You have tech companies, and these are premier tech companies. So Bravo, great choices. I love those two companies. Microsoft's the top position in the SPY, and Alibaba's the top position in emerging markets. So our strategy actually has heavy exposure to both those two companies. But right now, I have our group in cash, and we've been in cash for quite some time. But what's going to be the real opportunity when this VIX does hit 100, maybe even higher, and starts to come back down? What's a better strategy for the equities market? Well, what I'm leaning towards is trying to predict what happens next. What's going to happen before it happens? Well, my research tells me that the government's going to have to raise trillions of dollars through its bond market and fund the healthcare and biotech industry. So that means we're going to have a direct handoff, potentially of trillions of dollars in the next year or two, which will be put right into the private sector. Okay, so in our boot camp today, I'm going to reveal what those ETFs are. I'm not issuing a buy alert. Again, I believe the entire equity market will collapse unless there is some incredibly new change to monetary policy, which would either freeze the stock market or the Fed starts buying stocks itself. But keep in mind, they only have a $4.5 trillion balance sheet. The stock market's valued at probably 26 trillion now. So they would have to be willing to really wreck the value of the dollar to protect the stock market. So I'm not sure they're going to make that decision. If they just froze the stock market for 90 days, that might be a blessing for retirees who are losing money, rapid amounts of money, which I believe is just getting started. So our plan is to use the married put in the healthcare biotech sector after the VIX has spiked probably to around 90 to 100. And then we'll use some pretty clever ways to enter that position and then protect that position. So that's what I'm looking at for our group, for our equity exposure. And once again, I love Microsoft, I love Alibaba, but where's the money? Where's the crisis? Okay, it's in the healthcare. Who's going to benefit as the government raises billions and potentially trillions of dollars? What's going to be those companies? Now, do I think e-commerce is going to thrive? Probably, but again, it's not as big of an increase in revenue as the government literally going out and raising hundreds of billions, potentially trillions of dollars to deal with the crisis that to me seems unstoppable and should last at least a year, probably multiple years, unfortunately. Okay, so in our portfolio, we're in cash waiting for crash to get much worse. We're going to swoop in. Everybody else will be down 50 to 75%. And I do think it will go further than 50% correction. So everybody's going to be fleeing for the exits. They'll have lost fortunes, be probably people committing suicide. This is bad. I mean, imagine losing half of your entire nest egg in a few quick months. It's terrible. That's why I do suggest they just freeze the stock market for 90 days. Will they do that? I doubt it. Will the Fed come in and buy stocks? I doubt it, because it would wreck the dollar. So unfortunately, our clients are recommended to get the hell out of Dodge with equities, because the VIX is expensive. You're going to have to be crazy to buy stocks right now. So that's one. So that's a key difference, what you're doing versus what I'm doing. Two, we have 40% of our total assets in the TLT ETF. If you assume that the government must raise trillions of dollars to deal with the crisis unfolding, the Treasury, the 30-year Treasury product, has to be protected. So we all have heard of the PAL put for the stock market. I believe there will soon be a PAL put for the TLT. If this asset crashes with stocks, we will have Armageddon, Mad Max within a week. Okay, every single massive money manager in the world will be having extreme losses. So I think without question, they absolutely, as a number one priority, must protect the 30-year Treasury product. Will they let it possibly slip a little bit? Maybe. And that would give investors a longer period of time to buy into it and hopefully not push it into negative territory. But I do think that you can see the yield curve right here, that this is going to be pulled down to somewhere in this area, which would represent at least a 35% return on the TLT.
Hey, Jason.
Yes, sir.
I don't know if you saw in the news, the Fed just announced that they're going to buy treasuries across multiple expirations.
Nice. Oh,
500 billion.
And TLT's popping. I bet their call options up. All right. Well,
Stock market just jumped up, what, 1,400, 1,500 points.
yeah, but look at the TLT. Who cares about stocks? So the primary goal. Okay, so you guys got the news here before it hit the wire. That's what you're paying for. Okay, so yeah, the government has to protect the Treasury market. If they don't, the entire financial system collapses. The stock market is too big of a value. Okay, so that TLT is an $800 billion asset. The stock market's tens of trillions of dollars. So unless they want to wreck the dollar, which I know they don't, that's our single greatest asset, and probably the entire point of this, I believe, is an attack by China, Russia, and their allies. You can see they're hitting the oil market. They're doing all sorts of scrupulous actions. So I do believe we will be in a Cold War or a heated war with China and Russia in the very near future, unfortunately. But they have to protect that Treasury market. They have to raise trillions of dollars to deal with this crisis. So that's why we have 40% of our assets in the TLT, and it's now shot up to 163 because guess what? I was predicting at all costs they will protect that. That's the top shelf product in the world that all major money managers use to hedge risk. And so it's absolutely critical they protect this. What's GDX doing? We gonna pop on that? Yeah, GDX is popping. So if you followed our advice, you just made quite a nice little return in the last 15 minutes. Okay, so this, I'm going to put a comment. I guess you can't see the comment. This position is a high risk with really very little hope. So I highly do not endorse owning equities when the VIX is elevated. That's one. Two, let's see, so looks like you're trading, let's just say Anwar is trading around $1 million portfolio. Okay, so he's got, what is that, 400K in equities. He's got $0 in the TLT, bummer. It just went up 4%. Should be 400K. In GDX, he has, let's see, he has 1,000 shares. Wait, let's see, how many shares of GDX do you have? 2,000 shares. So GDX is trading at almost 25. So let's just round that out. 25 times 2,000 equals, what is that? $50,000. So he's got 50K in there. In my account, it's 120,000. He has this is the wrong GLD call option. Mine has more time. Don't want to own this asset because it's owned by HSBC. Use call options. Any return on that out of the money TLT call yet, or is that too far out of the money? So Anwar, this is I'm really glad you brought all your questions up. I think you can see, I can tell you're going to have a hard time selling that position. Unfortunately, there's no way to hedge it. If you wanted to hedge it for the time period, I believe we're going to have downturn, that would cost you a fortune. You would basically have to, if you wanted to hedge that for a year or two, I think you would jump your loss up to 55%. And you'd be betting that this crisis is over way sooner and that you would need these to appreciate by that. So this is a tough position. You really need a miracle to save these. So,
Hey, Jason,
yes, sir.
the long-term TLT is up nearly 30%.
Oh, that call option today?
Yeah.
Oh, nice. Oh, good.
Yeah,
You
for
guys,
whatever reason, I didn't get filled.
you guys needed a win today after
Yeah,
having to deal with that.
Nice.
After having to deal with a crazy 2 days. So I'm glad we're getting you some profits coming in.
Hey, I screwed up when I made the entry, and I bought the call for expiration, same day, $170 call for expiration March 20th. I said, damn it, I almost closed it out, and it's up 39, about 40%.
Nice.
So do you keep it or you sell it?
I'm going to sell it.
Yeah, I wouldn't sell it, guys.
Really? No, I mean the one I screwed up on,
What was the expiration date?
March 20.
Oh, yeah.
That's not very far away.
I think TLT is going somewhere between 200 to 300, just so you guys know,
All right.
in the next 12 months. So why is it, let's talk about why is the TLT. So, okay, well, let me go. So Anwar, you've got equities. We've told you not to have equities. You're going to hopefully not get killed on it. There's no way.
So many others, those are just two, and they are not the largest, or they are the largest, but there are so many others. I'm not, I'm in deep trouble.
Yeah. There's a funny movie that, anybody seen this video, Get Out, this movie?
No.
Oh man, it was good. That's my advice to equity investors right now, is get out. The big panic is not here, guys. Until we have people plopping over dead in the streets across all of America, the big panic's not here. Until the hospital systems are overran and we have tents being rushed to put up and the government's issuing huge fiscal policy, that's when everybody's going to finally pull the trigger. That's when Anwar is going to be down 50, 75%. And he's going to say, I can't take it anymore. And he sells that damn stock. He loses $500,000 or more dollars. That's when I'm going to be telling you to buy. Okay. We're not there yet.
Right now, I'm 23% down. So in the last 15, 20 minutes.
We'll see if you have the balls to hold once you're down 50 to 75%. That's when I'll be telling our group to buy.
I don't have the balls now.
Okay, so Anwar, bottom line is you're not following the program at all. But
No, I
hope-
just started and I
No, I'm not
have to
being mean.
comprehend everything.
Not being mean. This served as a beautiful lesson for our entire crew. So thank you so much. Let me just really summarize it. Here's what we're recommending is 40% of total assets in the TLT. It's now 12% in the GDX protected with a put. And then cash. Buy. Yeah, so we're going to buy some equities. Don't you worry. I want to make money on stocks more so than anybody else. Okay. But I'm just telling you, you don't want to buy when the VIX is at 65 and you can predict the future. Look at what's happening to Italy. That's about to happen here. Okay. So peak panic is nowhere near here. We're going to, if I'm right, we're going to clean up. And I think we're going to blow past that 15% return we had in March. Okay. All right, let's answer some new questions, and I'll come back to you, Anwar. Let's let Anwar let that kind of simmer for a little bit, and we'll come back to him with some questions and comments. Who
Got quite a
wants-
few in the chat box.
Okay, let me go to the chat box. Scotty moved his 401k 2 weeks ago, saved 28% loss of his life savings. Good job, Scotty. Way to have confidence. You know, I know, yes, there's been times that we've all been wondering what the freak is going on with that TLT when the stock market's limit down, for heaven's sakes. So just know every week, I only track 2 ETFs primarily, guys. SPY, TLT. So don't worry. I am watching those like a hawk and study every little piece of information I find relative, which is primary studying and predicting the future of central bank policy. So, oh, wow. We're at 165 TLT. GDX is at 24. What a hell of a call this morning, huh? Bravo to Portfolio Builder. Okay, Dan O'Connell, they just did today. Good. John, is that a typo on the TLT option? No, we want that time premium, John. That one's going to make us a fortune if I'm correct. Otherwise, it'll be a big loss. Disclaimer. Dan O'Connell says Fed just announced they're making purchases across maturities. So Bank of America called that this morning. That's how I knew. Ernest says you recommend 2-to-1 ratio GDX TLT. Do we apply that ratio to the number of shares or the value? Ratio of shares. Great question, Ernest. Yeah, so I'm keeping it based on ratio of shares because the prices are jumping up and down. So that make it so hard. You know, people will be like, oh, do I need 313 or 312? Oh, it went up 2%. Do I sell? So no, we're going to keep it on ratios to make life easy. Kathy says, am I correct? If I own 100 shares of TLT, I should own 200 shares of GDX plus buy 2 puts. You nailed it, Kathy. Very good. Scotty says, typo on the May 15, 2020. No, I wanted the 2021. So did I get the wrong date? No. What was the mistake on? Scotty or was
Hey, Jason, can you hear me?
Yeah.
No, everything is correct. It's just that I had to do a little bit of a double take when I was entering because the brokerage nomenclature on the dates has May 15, and I was just deciphering your 515.
Oh, okay, good.
It's
Okay.
it's just typing the word in May. It's just a little quicker comparison.
Okay, very good. Yeah, so
that's
instead of
all.
doing the 5, do the May. And that way you don't confuse what's the day and what's the month. Fair enough.
Thank you.
Good suggestion. John says Ivy does not have the 2021 expiration. Call them up. Everybody has the same. It's all the same. Call them up, John. I bet you they do. That's odd. Anybody else in Interactive Brokers having similar?
Do you have a question, Mark B?
Yes, I do. Hey, Jason and everybody, good morning.
Hey, Mark, how's it going?
Very well, thank you. Better than about 24 hours ago.
Yeah, no kidding, huh?
Yeah. My question is, and I like was discussed yesterday, I've had to segment my different monies into different accounts because some are, retirement, some are IRS, some are Roth, and so on. The question is, does your puts have to be in the account, in the same account that you hold the shares in?
No.
Okay.
So yeah, I would, that's a common question. One of our clients, Murray, I don't think he's on right now. Where is Murray? I'm sure he's gonna have a bunch of
He was here
questions.
earlier for sure. Yeah, he's in here.
Murray? Oh, there
Yeah.
he is.
I'm here.
There's Murray. I bet
Yeah,
Murray,
I'm doing the same thing. I have stocks in some of my IRAs, but I'm doing the puts and calls over in your account.
when Murray first started, he had like 5 accounts. He's got a lot of money. So he had 5 accounts. At first he was like, all right, well, I'll do the whole system in each account.
I-
So
I
he's
went-
haphazardly logging into one account and another account. He's got shit everywhere. I was like, Murray, let's just pretend it's one big account. Use one ETF per account. And the bottom line is, if you want to have cash to spend,
Mhm.
I would use your option trades in a cash account. And then I would try to get away with a lower tax rate on holding your ETFs in retirement related accounts, because potentially we can hold these for quite some time without ever selling. The TLT, for example, I think we can hold for at least a year. And again, now that I'm seeing what the hell they're going to have to do to resolve the underlying problem, TLT could go way, way higher than we all dream possible. I'm saying between 230 to 300 is my new range that I don't think
Wow.
is just possible. I think it is, I don't think America will survive this catastrophe unless it goes to that level. Let's just put it that way. So it'll be critical to America's survival to drive that interest rate low and to raise trillions of dollars. Is Oscar on?
I haven't seen Oscar.
Yeah, so I've been talking to Oscar privately about what this is going to cost based on just if we take percentages of who's going to get sick that are way, way, way too low, like just way too ridiculous low, like we'd be seriously spared by God if we get rates as low as me and Oscar have been speculating. It's going to cost trillions of dollars to do what we need to do. If we get numbers that are like Italy, it's going to cost tens of trillions of dollars. So once you understand that, you realize the resources have to be pulled from somewhere. Resources don't just come out of thin air. So those resources are going to come out of the private sector. Okay. It's going to be raised into the government and then handed off to healthcare companies. So I think at some point, we're going to make a fortune investing in the right healthcare ETFs. And I've got a group, each ETF is completely different, gives you a beautiful exposure to all the different industries we want to take advantage of, which I, again, believe are going to be handed billions of dollars by the government to try to solve this crisis. Now, the only thing that would change my mind is, again, this disease just disappears. But I don't think that's going to happen, unfortunately. Okay, who's got a question?
Hey, this is Mark. I've got a comment. So my sister had a flight to Florida for April. An American would not give her a refund or a transfer credit without a penalty. So she'd been holding off, and then they finally did. And she said that the lady that she talked to said that there's 9 people in her department and they've issued 900 credits this morning. There's 60 units like hers. That's one morning on one day for American Airlines.
Wow. Yeah, it's just this ripple effect. It's going to completely crush the economy. We're going to have negative GDP worldwide for months, maybe years. It's awful. very bad. Let's see, any other questions? I would like to have a small break before the boot camp. Again, for boot camp members, I'm sorry, I've been so laser focused on trying to predict the future here and make sure we're making money that I have not prepared a new boot camp module. So what we will do is spend some time looking at the ETFs I think will benefit after the crash. You know, the stock market's so tied together. I wouldn't dare buy these ETFs yet. But I think the time will be coming soon. Also, I would point out the 2008 crash, I think half of it you can show was 4 trading days of losing around, you know, max hitting the limit triggers. So we could get to the bottom quicker than people expect. And again, I do think that will be more than 50%. A lot of people, it's just so funny. Everybody loves to tell me what happened in the past with charts. I like to go compare charts in the past and use that as some mechanism to predict the future. I'll never understand the thinking behind that because people don't buy because of patterns in the sand. Or at least big money doesn't. So I think that's very foolish to assume that because you had a 50% crash in 2008 and you had a 50% crash in the dot-com bubble, that you guaranteed have. And in fact, one of the guys I've been following who's been so accurate, just remarkably accurate, he's only predicting a 40% crash, which blows me away. Let's just compare apples to apples. 2008, we had $300 billion of bad loans turned into derivatives, probably turned into a couple $1 trillion of potential investor loss. Okay, economy absorbed it, took about a year, and the stock market lost half its value. Okay, how much money are we going to lose in this crisis? Okay, it's going to be 10 times at least what we lost in total compared to the 08 crisis, no less. Okay, so I think we're going to see greater than a 50% crash. And that's going to really fool people who buy it. A lot of people are going to think 50 to 40% max. They're going to load up. And then I think it's going to crash another 50% from there. So I'm going to go with, this has so much momentum and panics ahead that are not yet here. I'm going to say it's more of a 75% retracement here from the top. My strategy to enter the positions once the VIX is just outrageously high will be to sell some puts with the intention of getting filled if it goes below into our healthcare ETFs. That'll be how we enter the position. Once we've entered the position, we will then, so the bet there is that we can sell the puts for a nice profit and not get filled and keep doing that weekly until the volatility has come down. And then we get the courage to actually buy it and then put an underlying married put below. So that's what I'm anticipating. Now, everything's unfolding faster than expected. I would bet we have people dying and hospitals overran by first week of April. So I think even if we do get a little bit of a reprieve in the stock market, just from people covering short puts, central banks trying to slow down this crash, you know, stimulus at the gazoo, I don't think we're anywhere near a bottom at this point. All right, let's see if we have any questions. I do want to get off here and take a break before the next boot camp. Any questions, guys? Glad we're back to making some money today after that scary event yesterday. So we held to our guns. We stuck to fundamental analysis. We've kept intelligent risk measures and risk management. And I think we're all going to be pretty happy here. So bravo.
Great calls, Jason. Great calls on TLT, GDX. Keep it up.
Well, thank you. Appreciate it. Any last questions before we prepare for the next webinar in 30 minutes? see, chat box. Yeah, so Michael, you should get a link. You should already have a link if you're in the boot camp. So check that out.
Oh
Replay
yeah,
link.
it's looking for replay links. You can click the same link, Michael, that you came in on, and I'll redirect it to the replay.
Yeah. So after this is over, give it like 10 minutes and go back to your email and click it, and you can watch it from the top.
I have a quick question about the boot camp.
Yes, sir.
I was sent a link to show me how to fill out the chart. When I tried to click on the link, it said I needed permission. I clicked on the little tab, request permission, and I haven't heard anything. So I haven't been able to look at that particular email that was sent to me.
Okay. You know what? I need to do a little bit of a revamp on the spreadsheet, hopefully this weekend. Not all of, so my software has a few features that yours doesn't have, primarily the summary tab where I have all my returns per month. You guys just have this on your summary tab. I'm going to program in as soon as I can these extra additions, and I need to update the actual ETFs in each category. So how about this? I'll promise to you, I'll get your spreadsheet template improved Saturday and issue everyone a fresh sheet. And by next Thursday, we will resume training on how to use your spreadsheet. The spreadsheet's really beautiful. Even though it's just a glorified color-coded calculator, it puts you on a whole new level because you can see what's going on and manage your portfolio far better. Now, I do try to lay it out so simple that we can all get it from this little blip, but.
Great. Sounds great.
Okay, perfect. All right, Ryan, let's shut down and we'll see everybody in 30 minutes. Appreciate it.